The Federal Reserve just cut interest rates by 25 basis points, but it looks like mortgage rates are actually going to be going up on this news. So, what exactly is going on? Well, it all has to do with what Federal Reserve Chair Jerome Powell said after the Fed cut rates. He said that there is not a certainty that the Fed will cut rates in December. The problem is that the markets that determine rates, have been thinking that this December rate cut was going to happen. They've been pricing it in at basically a 100% certainty. So when Jerome Powell came out and said, wait, not so fast, we're going to wait and see, we're going to wait and see exactly what the data says when it comes to unemployment and inflation, that gave markets some pause, and that's causing Treasury yields to increase, which means that mortgage rates are probably going to follow and increase by a small amount over the next day. So, why did Jerome Powell feel the need to send this strong indication to markets that they aren't necessarily going to cut in December? Well, over the last couple of months, the focus has shifted from high inflation to worsening unemployment. And as unemployment worsens, it seems more and more likely that the Fed would have to cut. But Jerome Powell wants markets to know that inflation is still a top concern. We are not out of the woods yet. Inflation is still above its 2% target, and the Fed will continue to monitor whether they need to worry more about inflation versus employment. Jerome Powell also called out the layoffs that have been observed across the economy and how those may be tied to AI as a reason to keep watching unemployment. He didn't rule out that there would be a December rate cut, but he wants markets to know and he wants you to know that it's not a foregone conclusion. We can't rely on the Fed cutting rates right now in order to stimulate the economy. We're still in a wait and see mode to see what the economy really needs. Does it need lower inflation, which means higher rates, or does it need a stronger labor market, which means lower rates? We probably want both at the same time, but the Fed really only has that one tool, and they have to decide which way they're going to go. I'm Daryl Fairweather, Redfin's chief economist, and if you'd like to learn more about how the economy is changing and how that affects you, follow for more.